it means a lot to all of us. It's really important. We have a great panel for you here with probably more experience in private equity and venture capital than anyone in Canada today. Our first panelist on the far right is Chuck Winograd. Chuck is the Senior Managing Partner and Chairman of the Investment Committee at Elm Park Capital Management. Elm Park Capital Management invests in non-bankable private credit of middle market companies. From 2001 to 2008, Chuck was the Chairman and CEO of RBC Capital Markets and Group Head of Global Capital Markets. To his immediate left is Gil Palter. Gil Palter is a partner and co-founder of Edgestone Capital Partners. Edgestone Capital Partners is a private equity firm that provides capital and strategic direction to middle market companies. Prior to founding Edgestone, Mr. Palter was the founder and CEO of Aladdin Capital Partners, founder of Aladdin Enterprises, and worked at Morgan Stanley, Smith Barney, McKinsey, and Clairvest.
So I couldn't keep a job till I got my own company.
I was just going to give you a compliment, Gil. Gil is one of the founders and one of the originators of private equity in Canada. And next to him is Bruce Croxon. Bruce Croxon is the co-founder of Round 13 Capital, which provides a platform for incubating and investing in digital startups. Mr. Croxon co-founded Lavalife in 1988 and helped guide it until its sale in 2004. Bruce is also the newest investor and judge on CBC's Dragon Den, and yesterday I watched him beat up a little kid. So today you guys will get some entertainment from him as well. So all of you know that private equity is a place that everyone's getting a lot of noise these days. There are huge pools of capital available in the private equity sphere around North America. Everyone says it's way harder to raise money in today's world, which it is, but all kinds of new investors are coming into this asset category in an attempt to get additional yield. Everyone is looking for alternative assets as a means of getting exposure to an asset class that they have not previously had exposure to. It's a very interesting time for the asset class because a lot of difficult deals have taken place over the last few years, and those who have survived and worked their way through it are reaching a point with opportunities that they've never seen before. This is a very heavily levered asset class generally, and one that depends on both debt and finding opportunities in the marketplace that others don't see. So let's start right from right to left in our panel, and Bruce, why don't you start, or Chuck, you start, I guess. Where do you see the greatest opportunities in private equity investing today, Chuck?
Yes, Brent, I saw the question, and basically I don't spend that much time thinking about private equity in a broad sense, but pretty well focus on one spot of it, which is the mid-market, which I might add is a very abused term in itself. The mid-market in the U.S. Particularly, and the mid-market in the U.S. can range anything between somebody in Phoenix with 15 people that are cleaning swimming pools to the bottom half of the S&P 500, depending on who you happen to talk about in the mid-market. But I look much closer to the lower end, companies 5 to 15 million of EBITDA and that can't get financing from a bank for debt and effectively come to a pool because they don't want to dilute. And so I just can't tell you what the other opportunities are because I really don't spend time focusing on them. I would say that in this particular business, it's again not the greatest opportunity in private equity because every opportunity has different metrics that make them more attractive or less attractive to different people. Private equity generally has returns that are in people strive for 20-25%. They may be striving a bit lower today. In our business, we strive for low teens to 10 to 12% to low teens returns. And basically, we do it with a much different risk-reward scale. We cannot hit the ball out of the park. We basically can just do better than other what would be fixed income investments. We take a private equity return because these are small companies and we have to be prepared to work them out or sell them if basically they don't work out. But basically what we do is we buy the assets at pretty well half the price that a private equity firm would buy them, sometimes a little higher. It's a combination of senior loans and secured loans. We try to be the only lender in the capital structure. Sometimes we are, and where the actual senior secured stops, the mezzanine begins, the mezzanine stops, and even a little equity piece begins as a matter of opinion, not fact. And that's what we really do, is try to develop an opinion on and try to do it. It's an excellent market, and I see from the second question I have that I'll go into, very interesting, because a lot of people have had to go out of it. And credit markets have retreated substantially more than in the liquid markets than they have in this particular market. So it's an interesting opportunity, and I'm not in fundraising mode, so I won't give you the real pitch, but it's very interesting. I put a good chunk of my own money in it, and it's something to look at. But it wouldn't be phrased the greatest opportunity, but it has a great risk-reward.
So, Gil, on the scale from little deals to big deals, from venture to late stage, from mid-market, small market to big market, where do you see the greatest private equity opportunities?
So on actually a different dimension than any of those, because there's opportunities in all of them depending upon what your strategy is. But where I have started to focus attention in the last short while is actually on taking advantage of some of the constraints of a typical private equity model, which is a limited partnership with a 10-year life, with a 2 and 20 fee structure, where you've got 5 years to put the money out and maybe 5 years on average to own the companies and do what you will with them and maximize your value. 5 years, actually, having done this for 20 years now, turns out to be not a very long time to own and build value in a business. So where I see a big niche of opportunity is to break out of that model, free yourself from the constraints of having 5 or maybe 6 or 7 years to create value in a business, and secure funding to buy businesses with an indefinite time frame of ownership, which doesn't mean you'll own them forever. It just means you're not owning them and starting a 5-year stopwatch the day you're buying them. You're owning them until it doesn't make sense to own them anymore, which means the industry dynamic may have changed, competition may have increased, your company will have lost its whatever the compelling attribute was that made you buy it in the first place. Inevitably, somebody may come along and ask you a price that is truly too good to turn down, because you could run the business for 3 or 4 years and still not get there in a normal market. So where I see a huge opportunity is aligning yourself with people who want to take some money off the table in their business, but not all of their money, who don't have a predefined time frame to have the thing sold, because the typical private equity firm, if they buy a share in a business and leave the founder in for a piece, it's going to all be sold at the end of the day, because that's the way a private equity firm typically maximizes its value. And partner with somebody truly for the long run. You can also make different decisions. Just as a private equity firm with a 5-year time frame can make different decisions than a public company trying to manage earnings quarter to quarter, somebody with an even longer time frame than that can again make different decisions than somebody operating to a 5-year horizon. You can 2 or 3 or 4 years into an investment make those next round of capital expenditures or strategic decisions that are only going to pay off in 3 or 4 or 5 years further down the road. So for me, that's where I see an opportunity, is to go where everyone else isn't, because the lion's share of the money in the private equity industry is constrained by that plus or minus 5-year holding period.
So one short add-on to that. So how do you feel about the opportunity for high net worth individuals generally, which you are one of today, as opposed to when you started?
So for high net worth individuals who are prepared to align themselves with, step back for 1 second. It's a lot of work to buy and build businesses. So if you are a high net worth person who wants to do it yourself, I think you're incredibly well positioned because you can move quickly, you can make your own decisions, and you can define your own time frames. If you're a high net worth person who doesn't have the infrastructure, experience, or capability to invest on your own, but you are prepared to ally yourself and support and partner with somebody who wants to execute that strategy, I think you can outperform in the long run the big institutions who by necessity are investing in people who are constrained by a typical model.
So Bruce, you're doing it at a completely different stage than these other two guys. So what do you think of the opportunities in early stage stuff?
Well, before I get into that, I'm sitting here listening to Gil, who was one of the investors in Lavalife, and I think I met you about 10 years too late then, because as soon as he put his money in, he was on me to sell the damn thing. So, it's all true. It's changing his colors.
Lessons learned. This panel is actually extremely interesting. I mean, Brent and Chuck were two of my mentors, and Chuck, through his role at RBC, has been a longtime investor in Edgestone, and in turn...
I became one of your mentors when you invested in me.
Well, actually, what I like to say, Bruce, is when I invested in you, I taught you everything you know. But
oh my God, here we go.
But I still haven't yet taught you everything I know.
Here we go.
But
Here we go.
But Bruce made more money. So
Here we go. Here we go. I'm coming clean. I'm on a private, it's funny that I'm on a private equity venture capital panel because I've just recently sort of crossed to the other side. I'm a lifelong operator and have sat across the table from good partners that have invested in things that I've wanted to operate. So I'm a recent advocate of investing in startups, early stage companies, and I'm, whether it's because it's where I've come from or I don't know any better, I think the biggest opportunity in Canada today is right where I'm at, which is in growth stage digital companies. And I'm talking about companies that are just past the point of proof of concept, so not raw startups, somebody with an idea on a napkin. I'm talking about digital technology companies that have a product or a service that have started to get traction, i.e. they've shown that people can want or need the product that they're offering. And borrowing a page from Gil's book, they've put some effort into understanding what it costs to get a user into the business. They've started to develop some kind of feel for what that user might be worth. And there's enough business knowledge that they realize that the difference between those two things is called a gross margin, and you do need a certain amount of that to cover your operating expenses. So we are past the startup stage, but as you look across Canada today, I've been around the space in 20 years. I've never seen so little capital at play at this stage of the market. If there's anyone from the banks in the room, I don't think we've got a lot to be proud of in this country for how we support businesses that don't have $3 million at least in EBITDA. We got to get off our ass and support companies that are below that stage, which, on the flip side, makes good opportunities for people like us because the banks aren't interested. So unless you think technology is going away, which I don't, or you believe that we don't have good fundable digital entrepreneurs that can hold their own with anyone in the world, which I also don't believe. I believe we do because I've seen it. I've been around it for 20 years. I think the spot to be for not low-risk returns, but definitely returns that you can brag about are in the digital technology arena.
That's cool. So now we've had three people basically tell us that the opportunities that arise in this space because the Canadian institutional market has left a vacancy for all of us in this space. Certainly when I started in the private equity business, my biggest competitors were TD Capital, CIBC Capital, people like that, and now those people are all out of the business, allowing us to take advantage of it. So Chuck, your opportunity greatly arises out of the fact that institutional investors have vacated it, and how do you feel about that?
Well, the way it's really happened is what has happened with respect to institutional investors and the banks. Well, a couple of things have happened, and I'll try to be quick. But first of all, we've got Basel rules with respect to banks as they exist in private equity, and as to how they make what I would call high-risk, liquid investments of all types, but that includes loans and stocks. And those rules have changed substantially. And just how you understand, when capital rules are there, and Richard knows more about than I do probably, but basically, when you price a loan for a bank or an equity investment for a bank, what you used to be able to do is apply a bunch of debt to the investment and get a lower amount of capital required. So you could say it was 40% leverage, or 60% leverage, or whatever it was. Now basically these investments have to be covered by 100%, and in some cases worse than 100% of investment, and therefore banks no longer have the incentive to do it. In terms of what other institutions have done, basically, probably the biggest one that has gone out of what I would call the private equity and the debt markets, and banks not only have gone out of it from the standpoint of having their own private equity businesses, everybody used to have one, and now nobody has one. That's in Canada, the United States, throughout the world. Secondly, they don't buy funds either. Because they have the same problem from a capital standpoint. So they buy more funds, they do make individual investments, but fundamentally they've gone out of that business. The other people that have disappeared have been the hedge funds, not disappeared as hedge funds, but basically making these types of investment because fundamentally they found out they were mismatched in 2008, 2009 when all their clients asked for their money back and they had liquid investments they couldn't sell. And so they've fundamentally got out of that business. That's been a very important impact on the business I do, but also on the private equity business because they look at, they looked at, some actually raised properly funded vehicles, and they were in fact mismatched for a lot of years before they found out they were mismatched. But basically, they've gone out of the business. So have a lot of the what I would call securitized players that have gone into businesses because securitized, and this is particularly focused on the what I would say the lower markets, and again, where you couldn't do a deal of $100 million or less to fund it, and in the upper markets where there is market access, particularly by retail investors who flow money through, for example, private equity, high yield mutual funds, the money is still there. To fund a lot of opportunities, but the money isn't there to fund opportunities in the lower markets, and this creates, I think, very interesting opportunities for PE firms and other funds that basically deal below the mid-market, higher than you're talking about from 3 million above, but basically anywhere between, say, 5 million to 25 million of EBITDA, where things are better. Of course. It's also the scale issue that basically people don't go into these businesses because you can't scale them up. I mean, these are actually labor-intensive businesses running these investments, and therefore it takes about the same amount of time, sometimes more, to do a $15 million investment than it does to do a $1 billion investment, and you can't scale up, so it's not as attractive, and that's become, it's not the same business. People can't get as rich in them, so they don't go into it. So that's created opportunities, I think, generally in the lower market, the lower end of the middle market, and there. Of course, to get those opportunities, you have to be prepared to accept illiquidity, and the real issue is how good is the illiquidity premium when you're in fact doing that, and it's been very good. She puts up a sign that says 1 minute. I feel like I'm in a boxing ring. Basically, you find out, okay, how much are you getting paid for the illiquidity that you're being asked? Because the disadvantage of actually having liquidity, of having a liquidity, is you can't get your money back when you want, which is sometimes quite inconvenient. So there is an illiquidity premium. It unfortunately doesn't trade because basically the time to buy these things is when they're high and when sell them is where they're low. And in fact, that's what people who are in the market see every day when they look at their deal flow.
Yeah, so I mean, it's, I think, do you think that the high net worth individuals, like the people in this room, really understand the fact that when they make commitments to our funds, that their calls are going to be intermittent, that they have to invest their dollars in other instruments while they're getting their calls, that there's a J curve, so during the first years of their investments they're paying fees, and and not realizing on those investments, and that if they want their money back during the 10-year period of the fund, it's difficult to sell them in the secondary market?
I think generally people, and having you know, I'm off the marketing trail, but having been on it, people generally understand illiquidity. It's sometimes when it faces them, when they need them, you know, they don't know, they understand that they know it or don't need it at a particular period of time. Circumstances change, and it becomes a lesson that they wish they would have paid more attention. But they generally understand that concept. They generally understand the concepts of money be called intermittently. The J-curve issue, which is basically that it takes time to get a fund started, is not as well understood. And probably would be more understood if people stood up at the beginning and said, you're not going to make any money for the first year because you're going to be paying us to get it. I haven't heard it said quite as clearly, and I've tried to say it clearly, but probably people who have been listening to me would say that I haven't said it just that clearly. It's particularly an issue in the type of fund I'm in, and
So here's
I don't think it's as well
here's the
understood.
here's the good news, and I am in marketing mode, so that's the caveat. But the good news is that in the digital economy, 10 years is a lifetime these days. So as opposed to when Gil and I had our investment in Lava, where we had barriers to entry with the technology we had, you could keep a secret, right? The internet really wasn't as mainstream as it is today. Today in the digital world, if you're not moving at the speed of light with your idea, somebody else is, and they're going to beat you. So what that leads to is a much quicker ecosystem where the exits are happening a lot faster. Now, it doesn't get away from the fact that you can't control when your exit happens, and all those illiquidity comments apply. But the good news is that it is happening faster in the digital economy than it used to.
Okay, so we're seeing it in our fund now. We're almost through fundraising, and a much higher percentage of the investors are high net worth individuals as opposed to institutions than was the case in previous funds. So Gil, you bought Bruce's business and lots of other businesses, and what's your most interesting experiences in, not Bruce's, I hope you're not going to give that, but we'll let him do that, in transitioning from an owner-operated business to one owned by a fund?
Well, actually, fortunately, Bruce's doesn't make the most interesting list. It was a very good investment. We had a great experience. But the most interesting transition from a owner-operated business to a professionally or private equity-owned business, there's a clear standout for number one, and it all happened actually on the day of acquisition. This particular company, which will remain nameless because the name doesn't matter, there's actually a dominant player in its niche with a very strong brand, but it was grossly undermanaged. And those are the kinds of businesses I've over a career liked buying, diamonds in the rough, where there's a real opportunity to take a gem of a business that others don't see its beauty because there's blemishes on it. The culture in particular of this business was, I guess, colorful is probably the best way to phrase it. It was owned 50-50 by a husband and a wife, both of whom were active in the business. And the sale of the business was necessitated because they were getting divorced, and they were getting divorced because the husband was participating in what seemed like a de rigueur activity at the company, which was sleeping with certain employees in the company.
We all know which one it is now, but go ahead.
It's going to remain nameless. You probably figured it out. But the senior executives were somewhere, and literally all of the top C-level suite spots were filled by someone who was somewhere between barely competent and incompetent. But more troubling than that, and the reason that four of the five of them had to be fired on the day of our acquisition, which was what made this so interesting, was they treated the treasury of the company like their own personal piggy bank. They would, without a thought, overpay suppliers in exchange for whatever each of their particular vices was. One loved tickets to the US Open. One of them loved Screaming Eagle wine. I won't go on. And so the day we bought the company, we had determined that we were going to, and we lined up replacements for four of the five senior executives. We let go of the president, the CFO, the VP sales, and the VP operations. We kept the VP of marketing really for one reason only. We needed some continuity in the business, and his only offense was sleeping with other employees, ironically including the same employee that the owner ended up getting divorced over. If you think that private equity is all sitting back ivory tower writing checks, I will disabuse you of that notion very shortly. So complicating matters was the fact that the VP of operations was an ex-Marine, and in my estimation, unhinged or very close to unhinged, and firing him would probably be the event that put him over the edge. He also was a gun fanatic who kept handguns in his desk, and probably there was always one in his body at any point in time. So on the day of transition, we had a fair amount of security. We had hired Kroll. We had a security guard outside the front door of the office. We had a security guard just inside the lobby, inside the office. And two guys who were going to sort of be physically near us at all times. One was as big as that wall, literally, an ex-football player. But the other guy, interestingly, was about 5'6", 130 pounds soaking wet. And I asked the case manager, I said, I get the human wall. What's with this little guy? And she said, well, the way we're going to work it is the big guy's going to stand in the conference room where you're going to be letting people know that they're being terminated as a physical source of intimidation. The little guy is going to be the one who walks down to their office and asks them to come down to the conference room. And we find from experience that it's much less intimidating to have him versus the big guy. And so you're much less likely to have your Marine guy go for his gun. But should he do that, fear not, he will find himself unconscious before his fingers find steel, because he's a 17th degree black belt in Taekwondo. So anyway, that was for sure the most interesting transition. It all went down actually quite smoothly. Nobody caused any problems other than the Marine, when he jumped in his Corvette as he walked out of the building, put his foot to the floor and banged up a few things as he peeled out of the parking lot at about 100 miles an hour in a big cloud of smoke. But that was certainly my most interesting transition and my most interesting day on the job. And fortunately, the investment worked out very well with the new management team. We almost doubled revenues in 3 years. We quadrupled profits, more than quadrupled our money, and that worked out.
Right.
I got another more longer one if you're looking for if you like the stories.
We'll let you have a shot. We know that there's no shyness on this panel. So take the other side of it. You're an entrepreneur who's built his business. Your kids are not ready to take it. You haven't taken any real capital out of the business for a lot of years because you've invested in it for a lot of years, or you're a young entrepreneur who started his business and believes he knows what to do with the business and he knows how to make it work, and he's offered from somebody like one of us some outside capital. How does he transition that, and what does it mean to him?
Well, I think it's a very important milestone, and one that shouldn't be contemplated casually, because you, in essence, are partners, right? From the time that money comes in, and it does change dynamic, and it does add a whole new set of obligations, and the process to go out and get that done. Can be quite distracting as well. I mean, it is time-consuming. It's time that you're not spent growing the business. Investor relations, a lot of it can fall into the non-value add bucket because you have to keep people updated, and that's time that you're not spent growing the business. So I think it's something that you need to think about very carefully, and I think you need to pick your partners very, very well. Having said that, again, I'm in the digital economy, and unlike 20 years ago when barriers to entry existed in the technology itself, I mean, when I started, the technology took up half of this room, and it was expensive, and it was a big black confusing box, and it took a while to figure it out. And now, 20-somethings are putting up code in their basement, and they're in business a week Saturday. So it's been a tremendous change. So all that is to say that if you're in the digital economy and you're onto something, the minute that you're onto it, and I refer back to the comments about starting to understand what your cost per user is, knowing what that customer is going to yield, it really is time to put the foot on the gas very quickly. So it's rare when there's enough capital in the business at that stage to, in fact, put the pedal to the metal. So entrepreneurs in that space that are contemplating bootstrapping it for another couple of years, I would suggest that in general, I'm making a very general statement, obviously, would be the wrong thing to do. The right thing to do would be to take some serious money in. And I think it's worth noting, too, that I keep coming back to this proof of concept point, because the valuation on your business when you have an idea and I think people are going to want it, or I think society needs this product or service, the difference between that and I've tested 10 channels to bring in users, and 4 of them are fantastic, showing that people want this product, I can get them at a cost that makes sense, and there's lots more of them to be had. The difference between the valuation of those 2 businesses are night and day. So we're looking for companies that understand that are at that stage, and that are looking for $1 to $5 million to go, like, to really put the pedal down on more of the same. And I would suggest that those businesses should be looking for the right partners. Everything I've said before about making sure they are the right partners still applies, and it still is a big decision. But in the space that I'm playing in, it's often the only decision. So it's not a question of whether you do it, it's with who. So that's been a bit of a change in my career that I've seen over 20 years. There was alternative ways to do it. Now, thankfully, because I'm on the other side of the table, I think capital has become a lot more important in the space that I'm focused on.
So when Gil and I come into these businesses, we know that we're completely dependent in many ways on the entrepreneurs who run the business. We
Yes.
show respect to them, and we know that it's their businesses. But they, on the other hand, have to deal with the governance issues that we impose on them, reporting, board control, our determination of when the proper time for exit is. So you hinted earlier that that was an issue that management and your private equity investor might not have picked exactly the same path at the same time.
I was joking. It all worked out well, but
Right.
but you do bring a different alignment of interests potentially. Like in our case, we were talking about it before the panel. We had 2 groups at 2 different stages of private capital that each had a different incentive in terms of timeline, and desperately so. In one example, not Gil, but
Yeah.
the round 2 are. The round 2 guys, it was the desperate agenda, right? So when you start dealing with those dynamics, it can be very distracting. The entrepreneurs in the room, don't forget, you're the person they've backed. Do not be intimidated just because it's money, and remember that we're lost without you, right? So you're the guy, a girl. So you've got the ultimate leverage if you're good at what you do. Because
And
they don't grow on trees.
It's actually worth highlighting for people who are high net worth investors in private equity funds. You probably realize this, but let me make it very stark that there is absolutely a principal agent misalignment problem with the general partners who run private equity funds. In the example Bruce is referring to, there was one firm that had come in later on. I think their cost basis was about 3 times higher or 2.5 times higher than what ours was, but that wasn't what the real issue was. Their fund was a dud, and they were never going to see carried interest on it. And as long as they held their interest in Lava Life, they were going to continue drawing management fees from you, the high net worth or institutional investor. So they were highly motivated not to sell this business because it would have meant a personal loss of income to them for no upside, no gain. And it was clear, and Bruce, I think, will corroborate, the exit was not driven by Aladdin, my fund's timing at all. It was the right time to sell. The competitive world had changed, as Bruce talked about. We were an early mover onto the internet. I remember Bruce standing behind the server farm with a fire extinguisher every day trying to cool it down. It was getting so hot the way the business was growing. But that first mover advantage was eroding due to competition. It was for sure time to get out. But we had one partner who, for their own self-interested reasons, was fighting it. On the other side of the coin, there's funds that have raised a bunch of money, may not have been able to put it all out, or coming to the end of the 5-year window that they're allowed to invest it, and they're highly motivated to make investments that they might not have made in year 1 or 2 of the fund life, because if they don't use it, they lose it, and they're far better off putting it out, earning management fees for the next 5 years on it, and they won't do a horrible deal, but hopefully making some carry off of it. So I think this is in terms of value added to the audience, if you're an investor in private equity funds, recognize there's not a perfect alignment of interest.
And Chuck, so for you manage your investments through covenant patterns and means of control through your debt instrument in these things, and how do you convince the borrower to take the kind of covenant pattern and controls that you would put into your instruments, as opposed to raising additional equity instead, or borrowing from traditional sources?
Well, first of all, they don't take it because they want to. They take it because they don't have any access to capital otherwise, and so we have a pattern, and we control it through a pattern. Although we also control it through being there and making sure we are there all the time in the same fashion that Gil is. Only, and you are, Brent. Only the difference is we don't care whether they grow. We just care whether they pay us back, and that is not a perfect alignment of interest. They've taken it for one reason. They generally believe, and I've met few entrepreneurs that don't, that there are 2 types of deals we do. Entrepreneurs believe their business is worth way more than it is, and they don't want to sell it, and it's never enough, and not only that, but they just don't want to sell it. And when you sell a piece of a small business, you do give up a lot of control. And so that is sort of the arbitrage. The other deals we do quite often are deals for private equity firms, generally in their second or third investment, where basically they can't put in any more money because effectively they've either reached their limit, or in terms of the percent they can put into a fund, or they just think it would be unwise. And they phone us up because it's a lot better to phone us up and charge them 15% than for them to phone up another private equity firm to get them to invest, because they know what they would do to another private equity firm if they got the phone call. So that's a big part of our business as well.
So
There's one way to address the misalignment issue. When you look at putting money into a private equity fund or a venture capital fund, just find out how much the principal themselves, how big their check is in. You know, they're not going to do things with their own money that's the way to get interests aligned in a hurry.
Yep.
So question number 1, right?
So let's go to that topic, because I'm sure in this audience that would be the most interesting topics for it. So you're a risk manager, Chuck. You've been managing risk all your life. If you're advising people in this room on the amount of leverage and the risk associated with investments in your kind of instruments or private equity instruments, what would you say to them about the risk reward for them and how they should allocate their own resources?
Well, first of all, the one thing that I haven't learned all that much in the business, but one of the things I have learned is the issue of risk of return. And that basically, when you have high returns, anytime somebody walks into your office and is trying to sell you high returns, you're getting sold that along with high risk. It just doesn't happen. There's temporary arbitrages around in the world, but there are very few arbitrages that last a long time, and so I believe that the best way to manage it is to basically hire good people, generally give money to people that you know and trust and have good records, either in the business or having done other things that you think are transferable, and make sure that they understand that their job is to hire good people or put your money out to good people. Because while financial engineering is good, private equity owners add a lot of value when they actually get into a business. In the end, the people that their biggest decision is who they hire to run the businesses, because private equity guys that run the business are the same as owners who coach a football team, and so it's something to be careful of. In the end, you're taking on risk when you do private equity. Commensurate with the return, sometimes the risk is a little better, but your real edge is going to be the people you hire to do it and your timing. I think that these investments, liquidity is a good thing, and at lots of times in the cycle, you get paid a lot for it, a lot more than in some respects you should. And people who are rich, quite apart from having advantages because they have money, have advantages because they actually are the only people that can. It's hard to be a liquid when you don't have money, and so it's one way to actually take your money. And basically, I always say, don't put the money you actually think you're retiring on into private equity. It's for other things, or into any high risk investment. You have to what I call securitize your life. Expenses, and then you deal with higher risk, higher return investments above that bar.
So why don't we see if there's some questions from the audience, and otherwise we'll continue. So I'm sure there must be some questions on a pretty controversial panel. None?
One?
Any?
Well, we've either been incredibly comprehensive or
Oh, sorry.
incredibly unintelligible.
We have probably the most experienced businessman in the room going to ask us a question, so you're in trouble.
Probably know many of the, not many, but quite a few of the major private equity companies gone public. And others are in the process of doing it. In Canada, there's very few, well, I know major one or two. So that means an investor, very few dollars if he wants to get involved in private equity, or buy their shares in the public market. What do you guys think of that?
So Gil, you have some experience in exits in private equity funds, so why don't you start with
So
that?
the question is, many of the biggest players in the United States private equity space, Blackstone, Carlyle, Apollo, KKR, to name the most top of mind ones, are publicly traded entities at this point in time. But in Canada, that's not the case, with the exception of Onyx and Clairvest. That isn't and who have both been public for a very long time. The U.S. Public companies are all fairly recent phenomena. That's not the case. If you're a smaller guy, not a big institution, and you want to play in the private equity space, why don't you just go and buy the shares of the publicly traded companies? Did I paraphrase the question? Or what do I think about that? So I think a few things. The first thing I think is that Carlyle, Blackstone are not actually private equity firms. They're asset management firms. I think Blackstone just crossed $200 billion of assets under management in the last few weeks, was a press release I saw. But those assets are across a wide range of investment strategies, a portion of which is private equity, but not even the biggest portion. Real estate is probably the biggest amount of assets that they manage, but they manage debt funds as well. Literally, you pick something that's an illiquid strategy and they probably run it. and they make an awful lot of money off of the fees that they charge on $200 billion of assets under management, whereas a traditional focused private equity firm should be making the lion's share of its profits from the 20% profit interest that it has in the businesses in which it invests. So I think it's a different business model. I think they're different beasts. And I think that you're getting a different asset if you buy the shares of the management company, so if you buy the publicly traded shares of Blackstone, versus if you invest in a Blackstone fund, you're getting a different thing. And it depends what you want. I won't say one is better than the other. As Chuck said, everything in the world is a risk-return trade-off. In the case of Blackstone, what you're betting on is that they will continue to be an in-favor asset manager that people continue to commit money to, and you as a shareholder in Blackstone enjoy your share of the fee stream that they earn.
Well, what you're saying is fundamentally the incentive changes when
Totally.
you go public, right? So it's ironic. I had a conversation about this yesterday with somebody that used to be with a large pension fund in Canada and has moved overseas to run some Arab money. And they were about to put a sizable check into, and I can't remember what, one of the big ones that was still private, and they made a large commitment. 3 days after they made the commitment, the company announced they were going public. He immediately got on the phone and he said, "That commitment I made 3 days ago, it's now half," because the incentive. He realized that the incentive that these guys had to focus on what the strategy and the return that they were presented fundamentally changed when they went public. And now it's the public's money and the gain that often gets reinvested, right? So it was a fundamental shift, not saying good or bad, but the incentive fundamentally changed. And I think you need to understand what that incentive is.
First of all, I mean, like any other answer, it all depends. But basically, it all depends on, as Gil described, what happens, what type of assets are in there. Some are worth more in terms of what you should pay to have asset management and what is a call on carry, and some are worth less. Mutual funds, because, for example, are used to be, but still have a pretty good repeatable asset repayment. And so they're perfectly suited for getting paid a fee on a management fee. They don't have less stable carries, so they're more easily and should be better priced in markets. Private equity, I remember the first time I had to evaluate a private equity company, we used a Monte Carlo simulation to determine what the carry was worth. Their fees are better, but not only there for 5 years, whereas mutual funds are probably there for longer. So it all depends on what things are priced at, and you have to look at it because it's quite easy to want to play Where's Waldo with what your earnings are doing, and that's what you have to be very careful of when you're deciding which of these investments you're going to buy. The other thing that is very important in terms of it is that basically it changes the way the firm runs, because it's harder to bring in the brightest people at the same prices and to get the same commitment you have when you have what is a founding group and people that can change by not having to sell the carry at market prices. And that is, of course, one of the reasons why these things get done.
So
Because the existing players don't want to give it away.
this is generally the U.S. ones that have happened have been an exit model for the founding partners of the private equity funds. They've created them for that reason, partly out of transition to the next generation of management. So you're betting on two things. You're betting that the next generation of management of those funds are going to be able to manage them as well. Also, they're generally only the largest funds. So in addition to what Gil said, they're generally only in the large markets, generally not in the mid-markets or the small markets. Having just being about 85% through our fundraising process for our fund, we're finding that institutions generally prefer the mid-market today to the large market. That's where they want to be. They think returns in those areas will generally be higher than the large markets. You can't get that through those public vehicles as well. And what the institutions impose on managers like us is a key man clause, which means that if we leave or we die, then the fund gets wound up. And it's done immediately. So the day that I kick the bucket, they immediately stop paying fees that day, and the fund gets wound up. So they keep their controls that way on the founders and the people they're backing, which takes us back to Chuck's point that generally in this business you're backing a team or a guy or a group of guys to manage your money. And you lose that control through doing it through the public markets. And generally those things trade at a discount to net asset value as well, as do any holding companies. So as a result of that, you'll never get full value for what you're getting, whereas every 5 years on a traditional private equity fund, they get liquidated over the next 5-year period, and you will return whatever the net asset value is in those funds. Richard.
You have a room full of folks thinking about this asset class. What advice would you give to a high net worth investor in terms of selecting a portfolio of private equity investments? How should you think about that, and what strategy should you have for this segment of your portfolio?
So let me give it a little shot as an introduction, since I've just been on the road for a long period of time and people seem to have asked me that question generally. There are a whole bunch of fund-to-funds that have been created to enable people to have a portfolio, a basket of funds, same as there have been those same creation for hedge funds. And traditionally, or for the most part, they have not performed better than just picking the right managers in the first place. You add another level of fees, generally 1 in 10, in addition to the 2 in 20 that you already have. So they have to perform significantly better than that to enable you to do better by buying a basket or a portfolio of funds. But as Chuck said earlier, this is a business of picking the right managers. And it's no different than the things that Murray, Ira, or Jonathan will talk to you about a little bit later. It's all in which manager you pick for outperforming those markets. The same happens to be true in this industry. Your due diligence by the typical institutional investors can be 6 to 9 months of daily review of your portfolio and your history before they choose you. And so generally, private individuals don't have that ability to be able to do that, so they have to rely on the institutions that have come before in backing you. So if you have CPP, teachers, people like that in your fund, generally you can rely on that. In other cases, you just rely on the history of the individual who's doing it. But I think the evidence is that a portfolio of these funds does not perform significantly better than picking the right manager. Do you guys agree with that?
Yes. The only thing I will add is the diligence that Brent is referring to that institutions do, which a high net worth can't do, is significantly more invasive than a proctological exam and probably less pleasant. They really, really go for it.
Go for it.
You find those exams pleasant?
You said less.
Oh, less, okay.
Yeah.
I remember walking out of my first meeting with an institutional in terms of their due diligence, they'd saying, I wouldn't want to marry your daughter. Like, it's unbelievable what they do to you.
So diversifying by manager may not be the key, but what about diversifying by vintage year?
A vintage year, it's a different story.
No, what you want to do is you want to be in the best vintage years. You don't want to diversify. Actually, in all seriousness, you really don't want to invest in the years that are record fundraising years. I mean, you can look over 20 years of history in this industry. It is cyclical like anything else, and the returns of funds that are vintaged in the big fundraising years underperform. You want to be a 2001 vintage fund. You don't want to be a 2007 vintage fund.
Excellent year.
We tell everyone
No, but
for another 3 months, it's a perfect year.
in the digital space, I mean, this is exactly what happened. The vintage year, they all piled in at all the institutions came in at the tail end of the bubble, and wondered why they had their hat handed to them in digital. It really was late, and we have had a history of moving slowly here.
The answer is that actually right now, since the financial crisis, it's been near nuclear winter in the private equity business. And as short as I can do this, The rule of thumb, if you were a $100 billion, I'll make it easier. If you're a $10 billion institution and you wanted to put 10% of your assets, so $1 billion into private equity, was you would commit $1.5 billion, because it's a commitment and it gets drawn down over time, and the first investments are sold before the last one's called. So on average, commit 1.5 to get exposure of 1. In the financial crisis, there was no realizations, there was no liquidity for 3 years, and companies needed support and the debt markets weren't there, so your 1.5 times got called. So for the $10 billion institution who committed $1.5 billion, all $1.5 billion got called. At the same time, your $10 billion turned into $7 billion because you got your head handed to you across the board. So all of a sudden, you were $1.5 billion of $7 billion long private equity, not $1 billion of 10. Your asset allocation committee said, oh my God, we got to get this back down to the 10% target. We're not going to commit to private equity until we get more realizations. And that still hasn't happened. So if you look at funds raised this year, it'll be probably the lowest year still, and it's been down every year since the peak of 07, first half of 08. So, and by the way, that's causing a big shakeout in the private equity space because the dollars committed are a quarter of what they were before, but private equity funds don't go away very easily.
And private company valuations are low as a result, because the capital just isn't available.
So the industry is shaking out, and it's very dynamic, and you need to be aware of what's going on because there's opportunities, but there's also issues. Institutional investors, as they're flexing their muscle, are actually imposing some draconian things that on the surface seem like they're in the interests of LPs, but they actually have unintended consequences that aren't so great long run.
And it's even truer in the asset category that Chuck's in, because when the banks are really active and very aggressive, then those opportunities don't exist. And when the banks are hurting, as they have been through the United States for the last little while, those opportunities are great. So it's interesting that there were a lot of mezzanine funds 10 years ago, and none of them were able to, with one exception in Canada, none of them were able to raise money again, and they all went out of business, probably at a time when it would have been best able to give them money.
Absolutely.
So the difficulty is that you need to understand that history is not necessarily a determinant of the opportunities going forward.
And I would just say that, you know, it's a vintage, not a bad vintage year, but is it a vintage year? Probably not, certainly not relative to what 2009 and 10 were, which were vintage years. They were vintage years as opposed to vintage years. The ones that, you know, when people are setting records, as Gil says, they're not vintage years, they're bad vintage years.
2009 and 10 would have been the time to put the most possible money into it. I'll give you one advertisement. So we spent 23% of our fund before 2009, 2010, and spent 70% of our fund in 2009 and 2010 because that was the right time to spend. Whenever nobody else was buying, that was the time to buy. And so hopefully that will result in returns over the long term. Time will tell. We had another question in the back. Shoot. Yeah, go for it. Can't see who it is.
I have actually a comment and a question. Comment is that for most high net worth investors, investing in a private equity fund is a real pain in the neck because you start off firstly paying 2% on committed capital, generally speaking, which means you're paying fees on money you haven't even invested. The first years, because of the J-curve, it's usually bad news, the reportable bad news. And you don't get paid anything along the way. You don't even get tax benefits for having it. So, and it takes forever. So it's very, very hard for the average high net worth investor just to endure being in a private equity fund. And I was encouraged to hear from Gil that there might be another model. And I have seen a couple of other models in the marketplace, but I would really love to know if there's any thought about making private equity investing for high net worth families a little bit more attractive.
Well, just to answer that to some extent, that's true of every real estate deal you do as well. You pay commissions to the broker, which means that that's on top of what you've done, and you have no liquidity in it. And if you're renovating the property or building the property, for the first few years, you don't get any returns out of that either. You know, it's true generally for almost any illiquid investment. I think that the most difficult part of it is that you don't know when your capital calls are going to come. And so You have a 5-year commitment. You could get called very little in the first year, nothing for the second year, something in the third year, nothing in the fourth year, a bunch in the fifth year. And if that happens, you have to find alternative uses for your money through that period of time. That's why what Chuck said is this is not an investment if this is the money you depend on to eat every single day. It's generally not an investment for you, and you shouldn't make it. You should only make it if this is your same money you would put into a shopping center and not worry about whether you get anything out of it for 10 years. It follows. Other guys have tried to make that simple. So Kensington Capital, as an example, has issued a public instrument in private equity investments and attempted to take all the money up front so you don't have that problem. But in our view, all you're doing is paying a bunch of additional fees for getting not much else. So you can make it simpler, but by making it simpler, you're going to pay another set of fees. It's no different than all the other structured instruments you see over the markets. You can buy one high-yield bond, or you can buy a portfolio of high-yield bonds and pay a bunch more fees to do it. You can strip dividends, and you can pay a bunch more fees to do it. You can do tax planning around all these things, and you can pay a bunch more fees to do it. So generally, it works if this is money you want to earn a higher return on, you're willing to take the leverage, and you're willing to take the illiquidity part of it, and you're willing to put it aside. And that's why it generally hasn't been an asset class that small high net worth individuals will invest in. But this time in our fund, it's become a very major part of our fundraising.
So I will generally concur with that. I'll add the following. Everything you say is true. 2 and 20 is a very lucrative fee structure for those receiving it.
I would hop in on that, but go ahead.
Yeah, so it is a lucrative fee structure for those receiving it, and obviously the flip side is true for those paying it. In private equity, there isn't always a J curve. If you're buying well, you're probably not underwater out of the gate. There's some friction due to transaction expenses. But the bigger thing I will say is, why is it the way it is? It is because it's lucrative. It attracts a lot of people in, and the industry has literally exploded in scale and size. There's well over $1 trillion under management, or there was at the high water mark in private equity, because it's so attractive. And if you really want to make money in this world, I have an expression: do not graze with the herd, because you're going to eat trampled grass. Go and find something else to do. And as my comments at the outset of the day, you said, is anybody thinking about a different model? I've actually spent a chunk of time in the last year and began thinking about it before then, realizing how competitive the space has been, what the downsides and the misalignments with LPs are. And stay tuned. I think you're going to start to see, not just from me, but from a select group of others, different business models playing around the mainstream that are more attractive. They create more attractive investment opportunities, and they're more attractive for the investors looking to invest in it. You know, when I started in this business in Canada back in '96, the playing field was a cottage industry. There weren't. I don't think you could name 5 funds back then. In fact, I put my shingle out on January 1st of '96 to be troubled to open the newspaper and see that RBC that day announced that it was getting into the private equity business. That's when, other than TD, the banks, TD and CIBC, the banks started getting into it. It's grown up and exploded since then. Time to move on or away from it. Your point is well taken.
I would just add to that basically there will be things happening in this end, and they're going to be very hard to happen, because what happens when you go out and try to sell something new is that nobody wants to do it, even when it's better, and so it's just hard. And that's true of individuals and institutions, because people don't like to step out away from the herd. Trampled grass sometimes doesn't taste all that bad. The issue that I think
pioneers find gold, but they get arrows in their butt.
Yeah, I think the issue that people have to recognize, and I'm sure when Gil comes out with something, as undoubtedly as well, and you see some people coming up with some solutions. You don't want to buy something that is a bargain. You want to buy something that solves one problem, where you're providing return, you're reducing the amount of the J-curve issue, but in return you're going to end up giving something up. Because if you have somebody offering discount private equity returns, you're not going to have the best people doing it. And because in the end, it may well be that they offer a discounted model because the market makes them do it, but they won't be able to raise enough money on a discount. You know, you don't want to bring the people that take the people that are going to run a small fund that have been running large funds for a lot of years and have great. They're not going to be there doing that. I promise.
But having said that, there's nothing wrong with the principle of aligning the win such that people don't necessarily need to get rich off of fees, right? So an alternative way to do that would be to lay out a budget on how you're going to run your office, that you need to get, have your rent and the highest quality people you can get. And if that comes out to 1.4% instead of 2%, it's 1.4%. That's what the 2% should be used for. What happens is if the funds get too large and the numbers get too large, you get a misalignment of incentive, because no matter what happens to the investment, and if I don't have my own money in there, you fall into I've got nothing to lose but my reputation and my ability to raise my next fund situation going on. So I'm all for aligning, put my own money in, put a budget out for the office. The objective isn't to get rich on the fees, it's to make money on the 20%, and you address the alignment issue. I don't know if that makes it any easier on the other points you were making, but certainly on the alignment, it should make people feel a lot better.
So just to conclude on that topic, this has not been an advertisement from these guys up here for you to give them money in, or to advise your clients to give them money under that scenario. This has been an attempt to sort of describe the industry to you in the most open way we can, and lay out the issues. My personal view is that CPPIB tried some of what Ian spoke about earlier, which is to negotiate different structures and different fee structures. It ended up being a huge disaster, and they've gone back to these traditional fundraising models because they believe that's given them outperformance, and it has. And you can see it in their numbers, which are public on a regular basis. So none of us really have to create the model. We can watch experts who have thousands of employees analyzing exactly that all the time. Anyway, on behalf of all of us, thank you to this panel for a great job. I hope you found it interesting.
Thank you, Brent.